Okay, so this video is one that I've actually been looking forward to doing. Lately I've been doing a lot of the strategy videos, and I guess to be honest, those can get a little boring, at least for me, and I assume they might be a little difficult to watch through, but I know there is some interest in those. This video though is a little bit more exciting to me, and what prompted it was we got asked a question on a demo. Basically someone was asking, what separates what we do with what other people do. So there's people online that they provide signals, they do blogs, they talk about strategies, but they're not really quant or algorithmic driven. And so I thought I'd do a quick video to kind of highlight what makes algorithmic trading a little bit different. And to do that, what I decided to do was I did a quick Google search of MACD trading strategies, and I found a website that had a example of some MACD strategies, and so I took a look at it, and I decided that maybe we would just code it up, and I would do that in front of you, and I would show you exactly how that strategy does. I'm going to keep the name of the website private because I don't want to knock anyone. That's not my intention. I know that there's a lot of developers and traders that have good intentions, and so I don't want to knock anyone, but I did want to just show how something that sounds like it might be a good idea, something that you might read in all the trading books, when you code them up, they really aren't necessarily good ideas and good ways to trade. So with that said, I'll kind of keep going here, but and I will mention some of the disclaimers. But what I'm basically going to do is I'm going to code it up. We're going to look at how it does. I'm going to optimize it and kind of show you the optimization process as well. So this video really has two purposes. One is to show how a strategy is coded up, how it starts with an idea to actually being coded, and then what happens next. So you optimize it, and then what do you do after that? What does the optimization even look like, and what does it do? And I think for most people this will be a pretty interesting video. So I look forward to doing it with you. So let's go over the disclaimer first, and then we'll keep going. So first off, the data that I'm showing in this video is, I just want to emphasize, it's not a strategy that we trade right now. This is just an example, but I do want to put all the disclaimers up so that people can see them, just in case someone does take what I'm saying as actual trading recommendations, which it's really not in this video. But trading futures does involve substantial risk of loss. It's not appropriate for everyone. We're going to be looking at simulated back-tested results for a strategy that I found online, just as an example. And so keep in mind that the CFTC rule 4.41 still applies. But with that, let's just kind of keep going here. So algorithmic trading, also known as quant trading, is really a mathematical evaluation of trading strategy. And so some of you might not be really familiar with what that means, but basically it's quantitative analytics provides insight into any given strategy. So in my opinion, it provides a starting point for further evaluation. Strategies, when you first look at them, probably 90% of the time, what sounds like it might be a good idea usually won't pass through the first kind of stage of evaluation. And so think of it as a strategy. You come up with a strategy, and what you want to do is code it up, and then basically try to determine if the strategy should get some further evaluation, or if the idea has potential, or if it's a horrible idea and no further evaluation is needed. And so really the biggest difference between what a quant trader does versus a technical trader or fundamental trader is, and by technical trader I mean a non-algorithmic technical trader. The biggest difference is that we try to focus as quants on being very precise. So when you write an algorithm, you can't just say do this, and then if this happens, then you should use a stop around this area. Everything has to be precise. Everything has to be very precisely defined because it has to be coded, and so you can't really write code that says use a stop that's kind of in this range. I mean you can, but it would have to pick a value in that range, and so things kind of move from being really fuzzy and very vague to being something very precise. And when you do that, you end up noticing a lot of things that you didn't notice on the first pass when you were looking at the charts. Certain trades that you didn't realize would be triggered end up being triggered because the rules are so precise that that they just follow the rules. And so so really algorithmic trading is, in my opinion, the only way that someone should do technical trading. And again, I mean, there are people, I'm sure, that are technical traders that do well, and they've never written a line of code, and they do their own analysis by hand. But my experience has been that algorithmic trading, once you start doing that, it really opens your eyes to a lot of the hidden data, and is really just, maybe it's because I'm an engineer and I love math, and so having something be precise like it is in math has always appealed to me. But as a trader, I do know that at times your emotions can get involved, and when things aren't clearly defined, when things are fuzzy, it's really easy to move stops or to kind of rethink what your original plan was, and before you know it, you're taking multiple losses and you're moving your stops and then getting back in once you do get stopped out at the exact wrong time. And so so I'm hoping that this will maybe motivate people to consider algorithmic trading, not necessarily my company, but just the field in their own trading, and that it'll be at least interesting to people that want to see an evaluation of just some strategy that I found online. So with that said, let's go on to the next slide. And we're going to look at this MACD example. So as I mentioned at the start, when I wanted to first look at this, I basically just did a real basic Google search of MACD trading strategies, and on the first page a website came up with a strategy. They start by kind of explaining what a MACD is, and they show that the default MACD values are 12, 26, and 9. And I won't go into it, but basically when you have a MACD, you're creating a signal line and a slower EMA line, and then there's also a histogram. I've always liked MACDs because I just like the idea of looking at kind of the acceleration of a movement as opposed to just kind of the velocity. And I always thought that was a really good way to trade before I was a algorithmic trader, quant trader. And I still think that there's probably really good ways to trade with the MACD. I have to be honest, the strategies that I use, I don't think any of them actually use a MACD. So this is something that has always interested me, but I haven't been able to get a really good MACD algorithm yet. But I thought I would use this as an example because it's something that a lot of traders are probably familiar with. But in the on this website, and again, I'm not going to share whose website this is, but they kind of comment on what signals are provided by the MACD. So they mention right up here a moving average cross. And I'll just quote from what they have. The most important signal of the MACD is when the faster moving average breaks the slower one. This gives us a signal that a trend might be emerging in the direction of the cross. Thus, traders often use this signal to enter new trades. Now, they're not necessarily saying that that's what you should do. So in their defense, they're just kind of commenting that a lot of traders use that. But when people say that this gives us a signal that a trend might be emerging, As an engineer, when I hear that, I just think, okay, well, what's the point? Yeah, it might be emerging, but it might not. So how is that exactly a way to trade? I mean, of course, it might be emerging, but you don't know, if it is, and if it is, how long it might last, when you should get in, what your stop should be. And so that's where I think kind of quant traders like myself can at times get frustrated by either books or just people that might talk in really vague terms like this. And I think we're all guilty of it at times, but the algorithmic trading that we do is much more precise. So we're not gonna say that it might be emerging, or if we do, then we use it in the context of a clearly defined algorithm that uses the percentage chances that it might be emerging in order to create actual trades that are back-tested and that we have data for, showing average gains, average losses, win rates, max drawdowns. So with that, algorithmic trading really just makes things more precise. Because when they're more precise, again, they're easier to follow on the emotion side. Okay, so what we're going to do now is we're going to actually, I'm just going to code up an algorithm based on that idea. Okay, so the first step is to create the preliminary idea from a chart. And so what I'm going to do now is I'm going to go to my TradeStation platform. I'm going to add a chart of the S&P E-minis. And what I'm going to do is I'm going to configure the chart to go all the way back to the 1st of May 2003, and we're going to use 60-minute candles, and it's going to be the ES, which is the S&P E-minis. So what TradeStation is doing is it's adding the S&P with a 60-minute chart. And so we can kind of go back, and you'll see that it goes all the way back. So here's 2006. And the reason why I'm using 60-minute charts is because I believe I read on that website that a common one used is 60 minutes. And so what I'm trying to do is follow, for the most part, what they recommend as much as I can, because the examples aren't necessarily as detailed as they need to be in order to actually code them. So I'm going to take some leeway at times to kind of fill in the blanks. But so at this point, what we have now is a chart of the S&P E-minis going back to May 2003. And what I did just now was I created a session that constrains this chart to only be valid when the equity markets are open, plus an extra hour until the futures market closes. And so that's kind of what that did. So the futures do trade almost 24 hours a day. There's about an hour break every day, and then they don't trade on kind of Friday after 6 o'clock Eastern or after 5 o'clock Eastern, but then they reopen on Sunday. So they don't trade kind of Friday night. They don't trade at any point Saturday, and on Sunday they don't trade until kind of the evening. And then Monday through Friday they trade 24 hours, but they take a break at about at 5 o'clock Eastern. They take about an hour break, and so all I've done is I've constrained the chart to look more like the equity markets might look like. And so what I'm first going to do is, now that I have the chart, I'm going to go ahead and add the MACD, and so we can kind of see what this strategy is that was being mentioned. Okay, so what I've done is I've added the MACD, and you'll see the yellow line is the fast line, and the teal line is the slow line, and then on the bottom is the histogram. And what I first want to do though is make sure that in TradeStation this strategy is set up with the numbers that they gave. So I'm going to format the MACD, and what they had was 12. Let's see, make sure I get it right here. 12, 26, and 9. And so we're at 12, 26, and 9. So we're tracking on that. And so really what they're saying by in that quote, where when the fast MACD goes above the slow, then that can signal a direction or a trend higher, and that because of that, a lot of traders use that. So what I'm going to do is just show you a few examples here. So right in here, you had the fast line. So here's the fast line, the yellow, and you can see right here, the yellow was still below the teal, but on this point right here, the fast line crossed the slow line, and this occurs when the candle stops. And so what that means is when this candle's created, this buy condition was met, and so we would want to be buying right here if we were going to follow this strategy. And looking at this chart, it looks like they might be onto something, because sure enough, the market did go higher. So so let's go ahead and look at the code though, and we can just kind of see exactly how well it does. So this is the MACD example 1, just the cross, and if you look at the code here, what you have is the basically just a description of what we're doing. First, we have the inputs, and so I have a stop as an input, a target as an input, and then we have the fast length, the slow length, and the MACD length. The variables are just my MACD, MACD average, MACD diff, and then a few others that I had from another strategy I had done. But what TradeStation does, though, and we're looking at the easy language code right now, is it'll give you this MACD function, and so we can pretty easily get the MACD, and this my MACD here, this variable, uses the fast length and the slow length, and that ends up being the slow line. So the teal line ends up being that line of code we just looked at. The MACD average just takes the exponential average of the my MACD and the length to create the faster line, and then the MACD diff is just the difference between the two, and that's really what the value of the histogram is. But so all I'm doing here is I'm creating a buy condition where if the my MACD, the current candle, so that's what this 0 means. It's basically an array. So 0 means if the current candle of my MACD is bigger than the MACD average. So what that represents is the fast moving average going above the slow moving average, but then also the slow moving average, or I'm sorry, the fast moving average from the previous candle is below the slow moving average from the previous candle. And so really all we're doing is we're saying that, as is the case here, the current candle, the MACD is above, so the fast MACD is above the slow MACD, and on the previous candle the fast MACD is still below the slow. So what that does is it creates this cross point where we want to be buying. So if all we did was said if the fast is above the slow, then it would be buying in all these conditions all throughout here. And so you want to also define the previous condition where it hasn't crossed yet, so that you can pinpoint the cross. Let me go back to the code. And so that's our buy condition. And so if we have the buy condition, if that's met, then what we're going to do is we're going to buy, and then this is just text that's printed on the screen, the next bar at the market. And then this code here, all it's doing is setting a stop and a target, because we have to have at least a target so that it can get in and get out. And I added a stop just so that we had a stop on the trade. So right now the stop is set at $500 and the target is set at $500, and the parameters that was recommended on the website, or that was commented as the default ones. Those are set up here as well. And so once that's all coded, then we just verify it. And once it's verified, I can add it to the chart. So I'm going to do that next. Okay, so to add the strategy to the chart, all I do is I right-click on the chart and I do Insert Strategy. And I'm just going to find this MACD example. There it is. So I'm going to go ahead and add it. And a couple things I want to do is, for now, I'm just going to set the look inside bar backtesting to 1 minute and let it go back 50 bars. I'm going to leave all this alone for now because I want to show you the effect that slippage and commission has. But once I add it, I can just kind of check it. So I have the stop set at $500, the target 500, and we have the fast at 12, the slow at 26, and the MACD length at 9. And so what it's doing right now is it's adding the strategy onto the chart so that we can analyze how this algorithm actually would do. Okay, and so first let's look at this point right here was the trade that we were looking at. And you can see that it does look like it applied the trade correctly. So you had the cross actually happened at the end of this candle, so it bought the next candle. It looks like it hit the $500 target, so that's good. And then right here, you can see that the fast length went below the slow, and then it was able to get above the slow again. And so we jumped back in right here. And then the most recent trade would have been, I guess, a couple days ago, when the same thing happened. And then we can look at this trade and see, okay, yep, it did the right thing. So right here, the so right here the slow was still, or I'm sorry, the fast was still above this, or the fast was still below the slow. But then on this one, you had the yellow finally went above this low, so negative 7.21 is bigger than negative 7.78. So the fast went above the slow, and it created another buy signal. But then you see it got stopped out here. So if I kind of zoom out, you'll see that all of these trades have been applied going all the way back to 2003. And so it's pretty much the strategy that was mentioned on that website. Now what we're going to do next is we're going to take a look at the performance report. And what you're going to see is that the equity curve on this, I believe, so it doesn't actually look horrible on a first pass. I mean, it actually is kind of sloping higher. But let's look at a few things a little bit closer. So number one, the profit factor is only 1.09, meaning that the gross profit to gross loss is only basically 1 1/10. Now, the other really important thing is we haven't even added slippage and commission yet. So what I want to do now is go ahead and add that. So if I go to the properties and we're going to do per contract traded, and this is just kind of the buy and the seller separate. So if it's a $6.50 round trip trade, and the round trip trade is $6.50, so each side is $3.25 in commission. And then the slippage that we're going to use is we're going to use 1 tick of slippage, so 6.25, and it's 1 tick round trip per trade, and 1 tick on the ES is $12.50. So we're breaking it up into half on the buy and half on the sell, and then same with the commission. So, and for initial capital, I'm just going to put it at 20,000 because that's what we use on like our our momentum algorithm, and also the Iron Condor uses 10,000, but this strategy would be trying to compare more to our momentum, so I'll use the 20,000. It doesn't really matter for the back testing, it just matters for some of the percentages that the reports show. The look inside, all that does is it allows TradeStation to look inside of the candles on 1 minute increments in order to see if a target or a stop was hit first. And so to be most accurate, you want this checked. It does slow down the simulations a little bit, but it's something that you really do need to have. And so now I'm going to close it. So what it's doing now is it's recalculating, and all it's doing is it's adding commission and slippage to each trade. And it's only one tick of slippage, which would be 0.25 points on the S&P, and then the commission is $6.50 round trip all in. Okay, so I think it probably has finished adding the commission and slippage. So let's take a look at how this algorithm did. And what you see is that as soon as you add commission and slippage, now the profit factor goes all the way down to 1.02, which means that the total amount lost was $236,000. This is trading one contract all the way back to May 03. The total gain was $240,000, and so the total net profit was only $3,677. So this, as it stands now, would be a horrible strategy. It would, all it would do would generate commission for the broker, but your account would just go up and down, and really would go nowhere. A few other things though, it does have a lot of trades, which is good, 892, but the percent profitable is really just a coin flip. The average trade net profit is only $4, which I guess that's really to be expected since our target was 500 and our stop was 500. But I also want to show you the drawdown, and so the drawdown is actually 13,000. So that means at some point in the backtested period, the account would have lost 13,000. And remember, we set the starting account at about 20,000. So a 20,000 account would have gone down to about 7,000 if it would have started right when the drawdown started. Now that's still tradable though, because with 7,000 you could still trade one contract. But forget about that for a moment. Let's just go back to the equity curve now. So before the equity curve looked halfway decent, but now you can clearly see that this algorithm would not work, once we add slippage and commission into the trades. But I want to say, even without slippage and commission, this algorithm still would not have been good enough, because the profit factor 1.09, we like to see at least 1.3 if there's no commission and slippage, and then once you add commission, at least 1.2. But 1.09 is really not good at all. With the commission and slippage, it's only 1.02, so it just would not have worked. Now, what I'd like to do now though is do a few more things to show you the next step that we would do if we wanted to further evaluate this algorithm, and that would be doing the optimization. Okay, so far we've done step 1 through step 4. So we had a preliminary idea from the chart, and in this example though, it really just came from a website that I found when I was searching for a MACD strategy, just because I wanted to show an actual example of how algorithmic trading is different from this other style of just regular technical trading or fundamental trading. Then I coded the strategy, and I already had it coded, so I just kind of showed you the code. We added slippage and commission, and then we did our initial analysis and compared the chart to the idea. And so that we kind of did a little bit of that out of order, but basically that's just double checking a few of these points to make sure that the algorithm is doing what we think it should be doing. But what I want to do now is the next step, where we can do some optimization, because what might happen if this algorithm was a real one that we were really looking at using, then we would look at the chart, and one thing you might see immediately is, oh man, we got stopped out here. If our stop was a little bigger, we could have held on and had a really nice gain. So what we're able to do is you can do things like this. We can go to format, and I can change the stop from 500 to maybe we make it 750. Let's just see what that does. And so you can see that we now did not get stopped out of this trade. We still got stopped out of this one though, but this one turned into a profitable trade. So if our stop was a little bit bigger than 500, at least that trade would have been more profitable. But let's just see what it does to the report. And so it's recalculating, and you can see that it actually does improve it a little bit. The equity curve, at least now, it's kind of steadily going higher, so that's a step in the right direction. But if you go back here, you still see the profit factor is only 1.08. And so, you know, the win rate goes up to 62%, and that's to be expected because our stop is bigger. But the average trade net profit is only 24. And the bigger problem is the drawdown is still relatively big at about 8,000. But what I'd like to do now, so even moving the stop, it helps some, but not. It still didn't make it an algorithm that is tradable in my opinion. But what I want to do now is show you how we can optimize it, because what we're able to do is we can basically shmoo all of the stops and all the targets, and even these lengths if we wanted to see if it can find a better number to use. So all I'm going to do is starting with the stop, we're going to use a stop of $100, and we're going to go all the way up to, for the stop, let's just do $1,000, and we're going to do it in $50 increments. Okay, and so what it's going to do is it's going to go through. It's going to look at a stop of $100, $150, $200, $250, $300, all the way up to $1,000, and then let us know kind of what it came up with. So that's what we're doing right now. So there's 19 simulations that it's going to run through, and we'll just kind of wait while it does that. But you can see the net profit with a stop of 100 is negative 6,874, so we know it's not going to pick that one, but you'll see it go pretty quickly through these, and it'll give us a final report showing what the most optimal stop could be. Okay, and so it's finished optimizing the stop, and now what we do is we can first take a look at the performance report and see how it improves, if it does. And what's a little bit surprising, I guess, is that it really didn't move a lot. It's still at 1.08, and that's probably because the stop that it landed on, wow, it actually landed on the stop that I put in there at 750. So what that means is that the $750 stop that I kind of randomly picked out actually is the best stop. And what this report here shows is what the profit factor is for each stop that we looked at. And so right here you can see if the stop was 100, the profit factor is 0.94, so it's a losing strategy. And it's a losing strategy all the way up to a stop of 450. But then you do see that as the stop gets bigger, the profit factor gets a little bit bigger when you get to 750, and then it kind of starts going back down. Although it did kind of jump up a little bit more again when we used when it hits 1,000, and so one might, increase that and maybe use a stop of 1,200 to see if it improves things. But I don't think it's going to give us a lot. So that would be the optimization of the stop. So in this case, 750 is the best stop according to the simulations. Now the other thing you can do is you can optimize the target. So right now I'm using a target of 500, but that was just picked out of thin air. So what I'm going to do is use a stop between, we're going to start with $200 and then go up to $1,200. And this time we'll do increments of $100. And so now that it's picked the most optimal stop, it's going to now look at what the most optimal target would be. Okay, so I'm going to do OK, and now there's 11 tests to run, and once this is done, then we will have a better idea of how much optimization can help this algorithm. And while we're waiting for this, one thing I want to comment on is that there's a big problem with algorithmic trading that heavily relies on optimization, because really all you're doing when it's optimizing is it's going back into history and finding the most optimal patterns for any given stop. And so a lot of times I'll use the example, if I flip a coin 100 times and log that on a piece of paper, I could write an algorithm that could find a pattern for that would say you have an edge if you get 3 tails in a row. Because in that kind of random pattern, maybe there were 2 times where it was tails, 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 and every time it was tails, tails, tails. 3 times, the next time was heads. And so I could write an algorithm that would loop through that sequence of random coin flips and basically create an algorithm, and it would, on a first glance, someone might that doesn't know a lot about statistics or doesn't realize that a coin is a 50-50 chance every time, they might think that that's a real algorithm, that, oh wow, yeah, every time you do 3 heads, the next one is a tails. I mean, the data shows it. But all that's doing is curve fitting, and the same thing can happen with algorithmic trading. And so you always want to be careful when you do the optimizations and not over-optimize. And so what that means is you want to use granular optimizations. So instead of like a $50 optimization, it'd be better to do $100 or $150 or $200. And if you're optimizing a something like a moving average, then you don't want to do 1 tick. You want to do something like 5 ticks, so that it's a lot more granular. So with that in mind, though, let's real quickly look at the performance report for this final optimization that I did. Okay, so you can see that the profit factor did jump up to 1.19, so that's getting a little bit better, and the average trade net profit is actually 69. The total number of trades is 710, and if we come over here, then it shows us that using a target of $800 is the most optimal number to use. And because you can see here that if you use 200, then it's pretty much break even, and then as the target size increases, you do kind of hit this point where it looks like it plateaus, and you'll also see that these 2 values also give you kind of decent profit factors. But I want to emphasize that these profit factors are still a little too low for what we would use and what we would trade. Although this is something that could warrant a little bit further investigation. So if I go back to this now, what we're looking at now is kind of the final optimization. Now, the only way I was able to get to this was by running through all the simulations to see what the best stop was and the best target. And what you have is kind of what we kind of ended up with. You see that it did have a few good trades when the market was going higher. When the market's going lower, it looks like it tends to get stopped out. There's one other thing I want to look at real quick on the performance report, though, and that's the maximum drawdown. So the maximum drawdown is still relatively big at 9,000, meaning that if someone had a $20,000 account, they could have suffered losses of about 9,000 using this strategy. So if I go back to the slide deck, so what we've done is I've done the cross optimization, and now the next step would be to consider this algorithm for further analysis. And really what that consists of doing is kind of checking over the data. So we'll do things like modify the inputs plus or minus 10%. So if I go to format, if I change the stop, if we go, let's just go down 10%, which would make it 675. And if I drop the target by 10%, that would make it about 720. So what I want to do is just see how that affects how the algorithm does. And so the fast length, we didn't optimize it, but we would still modify this. So let's go down to 11, which would be about 10%. The slow length, we'd go down to about roughly 23, and the MACD length, we go down to 8. And so and this is just something that I do, not every developer does this, but it's just to give you an idea of how much of a house of cards you have here. And so what I've done is I've just kind of modified the parameters by a little bit, and you can see that the profit factor jumped down by quite a bit. And so that would definitely be a kind of a red flag with this algorithm, the fact that it jumped down to the point where it was not tradable. To the 1.07 profit factor. Really, ideally you want to see kind of between 1.2 to 1.3 all the way up to 2.5. Anything above 2.5 usually looks more like a kind of holy grail trading system that I'm just really usually skeptical about. The biggest concern after changing the inputs, though, is that the drawdown went up quite a bit. And so what that tells you is that there are a lot of trades that it kind of pick the sweet spot, and if you change the inputs at all just a little bit, then the drawdown goes up quite a bit. The equity curve, I've seen worse ones. This one actually kind of looks halfway decent in some ways, except for this really big drawdown here. And so this is not the kind of algorithm that we would want to trade by any means. I will say that it did okay enough to where it might be something that could be looked at a little bit further. But in general, the kind of the conclusion on this algorithm is that it's not something that I would put a lot of time into. I might look at other ways this could be used, though, like what happens if whenever you buy, you always buy on a red candle. What happens if when you buy, you only buy on a green candle? I might use a state machine to create a pattern. And so instead of optimizing the stops and the limits the way we did, I might do a real rigid optimization using plus or minus $200, just so that we don't run the chance of seeing a lot of curve fitting. But then maybe add a state machine that says, okay, once you get this cross, then wait for a rally followed by a pullback, and then buy. Something like that would be something that I might look at. But the point of this is to show that the strategy, as it's defined very loosely, as we found it online, is really not a great strategy. But in the author's defense, I don't think he's saying that it's a great strategy. I mean, he's basically just saying when the cross happens, it might mean that a new trend is emerging, and so a lot of traders use that as a buying opportunity, and I think that's true. But with algorithmic trading, what we do is we look at the mathematics behind it. We look at it very precisely, defining every single possible input, so that there's no ambiguity, so that there's no kind of smoke cloud where no one really knows what we're talking about. So we like to be precise, and that's really what algorithmic trading gets you. It gets you the ability to analyze a strategy based on the numbers in a very precise way, without leaving anything to question. So that's what an algorithm is. I mean, in order to write the code for an algorithm, at least with these kind of algorithms, I'm not talking about like an AI algorithm, but but with these ones, you do need a step-by-step instructions on the trade sequence. And so I think that's all I have for this video. But I do think that I'd like to just, I guess, quickly summarize. So what seems like a good idea based on a basic search for MACD strategies turns out to probably not be helpful on a first pass look. This author has other ideas on ways to use the MACD, and I think what I'm going to do is in the next video I'll look at some of his other ideas he has, and I'll just code them up and we'll just see how they do. Who knows, maybe they are really good strategies and things that that people actually would consider trading. But as it stands now, this strategy is not one that we would trade. The profit factor was simply too low. But after optimizing, it did get a little bit better. But the only concern I would have with that is that almost any strategy can look halfway decent once you do the optimization. And so I've over the course of time, and many quant developers have gone through the same thing, you start realizing that optimizing an algorithm is not necessarily the best thing in the world. I still think that it's helpful because it can give you kind of the patterns of, okay, we can clearly see that as the stop gets higher, then the profit factor goes up, but then it hits a plateau. And so that does give you information that, generally speaking, for an algorithm like this, you would want a tighter or a bigger stop. And what would be interesting is to make the stop $3,000 and just see how it does. The problem with that, though, is that most people wouldn't want to have a stop that big. But those are just some of the ideas, and really you can go kind of crazy with the ideas. But what you don't want to do is take something like this and then keep layering in new indicators or new ways to make it better. You always want to be careful with that. I mean, in my opinion, the most indicators that should be used would be 2 or 3. And so if you have an algorithm that is looking at 10 indicators and is optimized, and it only goes back to, I don't know, 2009, then that would definitely be a case of an algorithm that more than likely is not going to work when traded live. Okay, so I think I've rambled enough about this strategy. Hopefully it was helpful, though, or interesting. Again, not trying to knock any other author or developer out there. I think the way he worded it was fine, because he wasn't saying that this is the greatest strategy in the world. It was more just kind of comments. But the biggest difference between algorithmic trading and other, whether it's live trading rooms or tutorial videos or blogs, is that for what we do, it's very much mathematical based. It's very clearly defined. We show the back testing with all the disclaimers, and we also do quite a bit more as well that I will be talking about, I think, in this video series. But basically, to give you a snapshot, if let's say this algorithm was one that we thought we would pursue a little bit more, the next step would be to do a walk forward analysis, and then also maybe look at a few other ways to trade a strategy like this. So maybe instead of getting out at a fixed price, maybe you get out when the MACD rolls over. Who knows? Maybe you actually sell short when the MACD crosses lower, or maybe that's when you get out. I mean, there's just so many ways you can do this. And I think on the website that had this strategy, I think he had a few ways to do it. One of them was using what was called that awesome oscillator. And so I think the next video I might add that into the strategy and see what it does to the performance. But for now, I think that's enough. So I hope you enjoyed it. This gives you insight into how a strategy is developed, how it's optimized, and some of the hazards of over-optimizing, and then just in general what separates algorithmic trading from non-algorithmic technical trading / fundamental trading. Hope that helps, and feel free to give us a call if you have any questions. Again, we do not use this strategy, but we do offer the S&P Crusher, which trades 7 strategies concurrently, and so if you're considering that one, just keep in mind trading futures and options involves substantial risk of loss and is not appropriate for all investors. And then the backtesting, I probably made it sound like that backtesting is kind of the greatest thing since sliced bread. Don't misunderstand me that that backtesting is a tool that can be used and it's helpful, and we do use it, but it's not the holy grail. So just because you have a backtested report that says an algorithm will do this does not by any way mean that it'll continue doing that well. If the backtested report has very limited optimizations, and if things like walk forward optimizations have been done that confirm that on the walk forward results it continues to do well, then you're a step closer, and if it passes all the sanity checks of changing the inputs around, and it can trade on volume, and it's not doing anything weird like for whatever reason not trading on Thursdays because it turns out in the backtesting Thursdays are bad days. If it's not doing anything weird like that, and it passes the walk forward and then can trade live for a little while and have decent results, then I think you're onto something, and that's a strategy that that we would offer. So we have our own design methodology. Feel free to watch the video on that where I cover it. Have some other videos on the website, but yeah, I'll definitely cut it off now. So thanks for watching, and have a great day, and I hope you enjoyed this kind of review of a MACD, very simple strategy that I found online. Thank you. Bye.